We're talking real money.
Wait a minute, I'm confused. This is Talking Real Money, the podcast, right, Tom?
Yes, it is.
Okay, wait. Why is there this other guy on my screen? I'm used to it just being you. Huh. Well, I guess we have a guest today. Hi, everybody. I'm Don McDonald in Florida. That's Tom Cock in Seattle. And down there, wait, what? Is that Mark Hebner in the Los Angeles area?
It is. Irvine, California, actually.
Irvine?
Just south of LA. Yeah.
Irvine,
right
California.
By John Wayne Airport.
All righty. Well, Mark, for those of you who don't know, Mark Hebner is the founder of an investment advisory firm with which we worked for a while, called Index Fund Advisors or Index
No
Fund?
S.
Yeah, Index Fund Advisors.
Yep.
That's what I thought. I thought I had it right the first time, and then I'm doubting myself. And he is joining us today on Talking Real Money to talk about, well, I guess, money. Right, Tom?
Well, and a whole lot more. I mean, yeah, he's way more than what you just stated, by the way. And Index Fund Advisors is one of the largest registered investment advisors in the country. Mark's a supplier of massive amounts of data on really how to invest properly, including his wonderful book, The 12-Step Recovery Program for Active Investors. It's always a pleasure to talk to you. We've done this before, but you're on a new crusade like you didn't have enough going already, right? With your outside life with the horses and everything else. Now you're taking on the entire investing world with your new crusade around returns, how people should look at various index returns. This is a fascinating topic. Should you just take the return of the index, or should we take the total return? And you're
okay. Before we go any further,
yeah.
For everyone listening at home, they're going to go, well, what's the difference?
I was going to ask him that. Yeah. What is the difference?
So let's back up a little bit. Our company just celebrated its 25th anniversary on March 5th, 25 years of helping investors and revealing what I like to call the science of investing, just like you guys. It's one of the reasons I enjoyed doing almost 100 podcasts with you guys, maybe more than probably 10, 12 years ago now. And we did many of those. And then we decided to build out a studio at our office. And then Tom came down and we filmed, I don't know how many videos, Tom, probably 50, 60.
Yeah,
and,
a lot.
We were a great team and it worked out great. But because we were celebrating our 25th, I was trying to come up with some interesting data points about 1999 and comparing that to today. And one of the ones I wanted to see is where was the Dow way back on March 5th, 1999? And where was it like at the end of February of this year? And so I went to my data gal, Kayla, and I asked Kayla, give me the numbers on both the Dow and the S&P. I just kind of like to see how they changed over 25 years. So she comes back. She's in the Morningstar database. She says, Mark, do you want the price return or the total return? And I had to scratch my head a minute, and I was a little embarrassed because I'm Mr. Index Funds. I got my book index funds, my movie index funds. I own indexfunds.com, and I got all kinds of index funds. And I was a little confused when she said price return or total return. And I think part of the problem, you guys are on the same page as we are. Dimensional has been providing historical return data that has always been total return information, a combination of not only the capital gain, the change in price, but also the dividends and those dividends being reinvested. Okay. It's basically a given in all academic papers that if you want to look at the performance of an investment, not an investor, an investment, you look at both capital gain and dividend. and that's known as the total return. So anyway, she asked me, do you want to see the price or the total? I said, well, gosh, I want to see the total. She says, well, if you turn on CNBC, you go to the Wall Street Journal, you look at Market Watch, you look at Barron's, you look at the S&P 500 website or the SP Global website, what you're going to see is price return. I said, what? So she gave me the numbers. And since for the 25 years, the Dow Jones price return, which is what we all see.
That's the increase in the value of the stocks without dividends.
That's right. The annualized return, Don, was 5.83. Now, does that sound like an equity return to you?
No.
It's basically a bond return over the very long period. And instead, when you include the dividends, it's 8.3%. Even that was a little bit low, but there was a lot of ugly markets. We had the .com, we had the financial crisis, we had COVID. Boom, 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 right?
Mm-hmm. Yeah.
And so listen to this. If you used the price return only, the current Dow is about 39,000. I saw yesterday it just crossed 39,000, right? But if instead you looked at total returns, and their file at the SP Global only starts in 1987, okay? So that means you have total returns with dividends from 1987. And when you do that, then it looks more like Dow 100,000. It's actually about 96,000 yesterday. Oh, I forgot. You can't see my hat. I put a hat on.
Look, put a hat on for us that says Dow 100,000. So the
Beautiful
equivalent,
hat.
what you're saying is the equivalent would have been 100,000 today. But this is really an interesting point because, Mark, this strikes me as the reason why so many, particularly those who are selling cruddy products, have been able to get away with underselling the return of the equities market. The story you always hear, the big story is that what if we enter another 50-year period where stocks underperformed like after the crash of 29? But so what you're saying is all that data is misleading.
It's misleading. And now I didn't see that particular study. And often that's a net of inflation return.
Mm-hmm.
That's really a long extended period. But listen to this. Just last year, the S&P price return was 24%, but the total return was 26%. And so I attended an economic outlook forum or little presentation by a local bank. They asked me to come. Normally, I wouldn't want to go to those things to hear the forecast, right, of next year. And the slide at the end says the S&P was up 24% last year. So I'm just sitting here, working on all of this just before that conference. And I had to raise my hand. I said, sorry, that's the price return. The total return was 26%. And of course, the guy he was a professor, so he wasn't too happy with that. And he said, no.
Don't contradict your professor.
Exactly. He said, no, that's the total return. I said, well, I hate to tell you, I've been working on this and I'm in the process of trying to change this so we don't have this very confusion. There was like 100 people in the room, and he's announcing that the S&P had a 24% return last year. So let's talk about the S&P. If you look at the price return for 25 years, that was 5.8% price only, right? Mm-hmm. And dividends was 7.8%. And instead of the current 5,000, they were just celebrating S&P 5,000. I didn't see any hats, but they were kind of excited about that. But we did Google. There were Dow 30,000 and Dow 20,000 hats, okay? So instead of being 5,000, if you include dividends, and what's the date on this? It's 1970 for the S&P 500, the start date. We would be at 24,000 on the Standard & Poor's total return with dividends instead of the 5,000 that we see now.
So 5 times higher, in essence, because of the effect of the compounding on those dividends.
Wow. You got it.
Okay, but all right, now but to change this, I'm hoping it doesn't require Congress or anything because that could be several decades. But all kidding aside, how do you go about fixing this if indeed it can be fixed?
So it can be fixed if you go to the S&P Global website. So they've merged. They have like a joint venture between the old Dow Jones company and the Standard & Poor's company. It's now called SP Global. And if you go to any of their pages where they show the returns and the current level of the Dow, of the S&P, there's a little drop down. And the default is currently price return. But if you click drop down, you can choose total return and see it. And you can get this data right there from their website. Now, on the S&P, they use a file that starts in 1989 instead of 1970. Okay. Don't want to get too complicated on this, but if you don't know on all these start dates, then you get different values right at the end. But it's all right there. They've been tracking this for years. And so all that needs to be done, I actually spoke to a senior data analyst there already, and he was trying to convince me how total return was better. I said, wait a minute, that's why I'm calling you. He said, basically, all I have to do is switch their defaults that they're showing throughout the website. They have a scroll on the homepage, and they have all these price-only returns. Now, here's the other crazy thing. In 1987, the Germans decided they were going to change the whole structure of their index of their top, I think it was 30 companies at the time. Now it's called the DAX 40, okay? And they sat down and they said, well, wait a minute here. The correct way to calculate this index and to look at a performance of an index is to use total return. So they switched in 1987 and have been reporting total returns ever since. So this is even now more confusing because I've seen on CNBC on the same screen a DAX index and a US index that's price only, one total, one price. And I actually did a screenshot and posted it and said, here, we're mixing them up. Go ahead, Don.
Well, you have the media, though, that has to buy into this. Let's say S&P says, sure, we'll change the default.
Yep.
But isn't there a vested interest in the financial services industry, the folks who fund the media that reports this? Isn't there a bias towards a bit of bearishness? And if they're reporting these bigger numbers, doesn't that make the bears case look a lot less convincing?
So Jason Swag at the Wall Street Journal, one of our favorite journalists, has been writing about passive investing now for 20 plus years. Jason, we got in touch with him because we were hoping he could do a little article. He writes back to us immediately and says, Mark, we wrote about this in 2011. In fact, we wrote 2 articles. And he says, I would classify the reasons for the lack of change into 2 categories. The first one, laziness. That doesn't make me happy. The second one was deceit. And that doesn't make me happy either. Neither one were very good. And he did 2 articles, which we'll be posting on our petition page. I've started a petition just in case when I get somebody, on the phone. I'm trying to get the entire world to switch, Don. So when I get somebody on the phone, I can flip over to my page and say, hey, look I have 1,000 signatures here who agree that this is not good.
Yeah, but the index annuity salespeople are going to hate you.
Yeah, because they don't include dividends. Yeah.
So Jason Swag wrote 2 articles. In the second one, he actually uncovered that even Jim Cramer was comparing, maybe not even, Jim Cramer was comparing his stock portfolio to the price only. And his portfolio had dividends, okay? This is the really bad part.
So it's apples and oranges.
Yeah, just your broker. In fact, most brokerage statements have the client's performance next to the price-only return. This thing is so pervasive. So another professor wrote a paper on this, Sam Hartzmark, and he actually did a show on the Rational Reminder. Those, our buddies up in Canada, Ben and Cameron. And the name of the paper is called Reconsidering Returns. And if you Google that, you'll find it. Also, there's a link to it on my ifa.com/petition page. This is where I have all this information. This is not really to pump my company. Although, it's funny. my wife is going, why are you wasting your time on this? Well, in some respects, people who are thinking about buying an index fund and then sees these returns of 5.8% for 25 years.
Why do
going,
it?
Wait a minute. Why would I do that?
Yeah,
right?
I agree.
So this is really confusing for us who are educating investors that they should be using index funds if the data they see just about everywhere is only the price return.
We're talking with Mark Hebner. He is, of course, the president and founder of Index Fund Advisors, author as well, and now driving the petition to change the way we think we hear those numbers. I'm just waiting to see how that's all going to shake out. But let's take up another couple.
Rabble rouser. That's what he is. He's a rabble rouser.
Trouble causer. Let's take up a couple other topics here because they've been in the news a bit. And we got to ask you about this. I read with great interest in the Wall Street Journal a couple of days ago that all of the billions that have been flowing into Bitcoin exchange traded funds from individuals. I'm assuming, I hope I'm not making a bad assumption, that Index Fund Advisors is not among the advisors that is using or will be using a Bitcoin exchange traded fund anytime soon. Where are you on Bitcoin ETFs, sir?
Breaking news. We're just getting the earnings report on a Bitcoin. Turns out the earnings for Bitcoin last quarter was 0. This is the problem.
I think that was every quarter, wasn't it?
Pretty much. Going
well,
back.
I was just giving you last quarter.
Yeah. Oh, okay, good.
So the value of anything is basically the present value of its future earnings. That's why those dividends are so important, including the value of your securities. And so you really should be thinking about any kind of currency or commodity. I think the IRS, last I saw, classified these as commodities, okay? Mm-hmm. And that commodities like gold and silver have basically had returns close to a 1 or 2 year bond fund, very close to inflation, and huge volatilities for the last 45 years. We have a nice chart on that on our website. And so my guess is we're going to see something similar here. We're going to see maybe a slight inflation on average return, and you're going to see huge amounts of volatility like we've already seen. That was already up to 64,000 and then went down to 30 something, and now it's back up over 70. And it's just not an investment. It's something to speculate on. And let me clarify that. I think of as an investment as a company that makes a profit. And that's why investors want to own it. Either they take those profits and reinvest them in the company and build the company to be larger, or they issue a dividend. And just go read Warren Buffett's write-up about why gold is such a silly investment. You could probably Google it. He wrote it up in one of his letters. And he made the point out, 50 years later, a bar of gold is still a bar of gold, One of the things they like to say about the Bitcoin, well, there's only, 21 million of them, or there's some limited amount of them. But now all of a sudden I hear them talking about Ethereum. Oh, so here's another one. And so this thing is not.
And after Ethereum, there are another 8,400 of them behind it.
Thousands. Yep.
Yeah. Well, I'm glad you took the heat off me.
Yeah, Don gets a lot of flack from this.
I get a lot of flack,
yeah,
but the fact is, you compared it to gold, which I think is giving it far too much value, because at least gold can be turned into something.
It can be turned into jewelry.
Whereas you can't turn a Bitcoin into pretty much anything except maybe a pizza at a strange little pizza joint somewhere that is run by conspiracy theorists. And I
think El Salvador.
Yeah,
there you go. Yeah. So help yourself.
So I don't know where this is going. Listen, anything that shoots up in value is going to get the attention of what I'll call the speculators, the gamblers. And it's just kind of silly. I made the same comment to David Booth. I said, hey, I hear you're coming out with a new Bitcoin ETF.
I bet he liked that idea.
Yeah, right. He said, I just did an interview with him.
It's curious that Vanguard won't touch them, that a company like DFA won't touch them. And the companies that touch them, you get the feeling. Did you ever watch the old Bob Newhart show
Sure.
with Larry, Daryl, and Daryl?
Yep.
What was the name of their company?
Don't know.
Anything for a buck.
No, anything for I
Anything
didn't.
for
I
a
did not
buck.
remember that.
Anything for a buck. That's how I feel about these guys who bring out these products. It's, hey, if they're stupid enough to buy it, we'll give it to them.
Yeah, and let's since you brought
What
up
else?
Mr. Booth, and of course he's been the operative guy at Dimensional Funds for, gosh, is it 40 years now? A long time. I mean,
43.
43 years.
43rd. It was
Yeah,
1981.
and you've always been kind of a dimensional guy. Now, there's other people in this business, right? Certainly, because we get asked about them a lot, and we use some of their products, Avantis, iShares, et cetera.
Yeah.
But let me ask you this question, because this one's one we get all the time, is we say you should be using passive or rules-based kind of funds, and others say, what? How is that different? I mean, is Dimensional really a passive house? Is
They
Avantis
call themselves active.
I know. So it really gets to be very confusing. How do you answer that question?
So first of all, the active label relative to the ETFs has to do with a rule that came out that said they didn't have to buy all of the shares with every creation unit. Okay. So they can sell a sort of sampling or buy a sampling of those shares. And that's different from the original index-based ETFs. Okay. So, unfortunately, that's where the active label comes about. So you probably also have heard them use the term systematic, right?
Yeah.
But my favorite description is a index fund is a set of rules of ownership that are held constant regardless of market conditions. And if you go to the SEC's website, they have bulletins, and I also have these on my homepage to clarify. Because
just to stop you, what isn't on your homepage? I mean, right? I mean, am I missed? I mean, that all kidding aside, if you want to know anything,
it takes about an hour to scroll through the homepage.
I mean, jokingly around your office, he used to say, "Mark knows that more is more." I just tease because, honestly, if you wanted to go to one place to learn everything there is, and if everybody ever asks a question of Mark, he says, aha, I hadn't been asked that before. I'll put that on the web. It's there. Every study, it's fantastic.
That has been my motto.
More is more.
So, but back to the point, because I think it confuses people, because for years, we always talked about passive or index.
I know.
You've talked about passive or index. Yep. And now suddenly, because of some of these changes, because everything is going to ETFs. I mean, it feels inevitable to me.
So it's not just the ETF, it's the rules of construction within the ETF. So what I was about to say, if you looked at my homepage, we dug up these bulletins from the SEC, okay? And the only reason we have them there, Tom, is because we're index fund advisors, and even DFA says we're not index funds, right? So turns out they have two bulletins. One refers to the traditional index fund, and that's your S&P 500, your Russell 2000, whatever it might be. And the second one is called non-traditional index funds, and that specifies factor funds.
That's the best answer we've ever gotten, by the way, including from Dimensional or Avantis.
Avantis, yes.
That's the best. So well done, sir. No surprise.
Read this, you'll be shocked how similar it is to exactly what they're doing. And it's basically the SEC's kind of warning that you're not going to get the traditional index, Russell 1000 value that you think you know about, because these firms have custom indexes. It actually uses that language. And it also brings up environmental, social funds as being non-traditional filters, or think again, a set of rules of ownership. So
the term rules-based investing may be the best way to describe all of this in aggregate.
The other reason I like that, again, I just had a conversation with David Booth, and we talked about how Ken French in the early days of Dimensional came up with like 13 additional rules for managing their portfolio among their portfolio managers. One, for example, if a company files bankruptcy on a specific date, they're going to stop buying it. Other index funds would continue to buy it. That's not one of their rules. And so there's a whole bunch of these sort of exclusionary rules that they established early on, and they checked many years later, and they were all very helpful.
And we're just about out of time.
The factors are the inclusionary rules, and then they add these exclusionary rules to get potentially underperforming assets out of the portfolio.
Yeah, so I can't tell you exactly because I don't have the 13 rules in front of me, but I can just tell you there are modifications.
Wait, we can go to your website. I'm sure they're there. I got to be there somewhere.
I had them a long time ago, and somehow they got lost, and I haven't been able to dig them up again. Maybe I'll get one from a trader over there.
Hard to imagine they could get lost. We're out of time, but we want to make sure that we allow you to plug your new, everything that was old is now new. Your book, the Index Funds, a 12-step recovery program for active investors. The old one required 2 Sherpas to bring it up to my house. The new one is much smaller. It's easier to read. But what else is different about this?
So Tom,
and where can they get it?
We like to say the old one was a good doorstop because I don't think many people cracked the book and even read the darn thing. It was so heavy. It was a great doorstop.
Well, we used it during hurricanes to keep the doors from blowing open. So
it's all working.
Yeah. So, and it's funny, I sent out some of these to people and they hadn't bought my other versions of the small book, and they were all surprised that we had reduced the size of it. So I like this. It's the same size as the Little Book series.
Yeah.
Jack Bogle's Little Book of Common Sense Investing has been the #1 mutual fund book since 2007.
I didn't know that.
This?
Yeah, but wait a minute. If you got that big book to that size, what is that, like a 3-point font?
No.
It's got to be like insect-sized font.
Obviously, we had to cut out a bunch of
Put
it,
the
right?
Okay, all right. So it's been edited. It's abridged. Mark, thank you so much for all this fun information, and good luck on your quest for the Holy Grail.
We'll be watching.
We really wish you well, King Arthur. And when you succeed, let us know.
You're going to know because that TV is going to change to a different number all of a sudden.
And your website is ifa.com.
Yeah, as it's always been.
Easy. Not easy to get a 3-letter domain, guys.
No, sir. We know it. We know it?
Indeed.
Mark Hebner, we really do appreciate talking with you again. It's been a long time. Let's do it again soon.
So much fun. Thanks, guys.
All right. Thank you all for being a part of this special edition of the Talking Real Money podcast. I'm Don with Tom and Mark Hebner because he does this too. We're all talking real money.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. Is anybody still listening?